As the world's second largest economy and the world's biggest consumer of commodities, as well as South Africa's largest trading partner, the slowdown in Chinese economic growth cannot be underestimated in its importance. Now, China has slowed down from double-digit rates of economic growth towards single digits, and maybe even lower than the current numbers are telling us. And we have to ask ourselves why. And the reason why is because China used debt in order to drive economic growth since 2009. When the global economy went into recession, China decided they didn't want to go into recession, and they used debt and stimulatory economic policies to create growth. And they were successful at this, but that type of policy has to come to an end eventually. There's only so much infrastructure and buildings and cities and bridges that you can build. And I think we're starting to see that type of policy come to an end in China. So that's the problem that China's running into at the moment. It's struggling to produce the same levels of economic growth, and that's why things are slowing down there, and the demand for commodities and the demand for South African goods and services is weakening at the moment. Now, it's not all doom and gloom in China. There are pockets of strong economic growth and productive activity in places like Beijing and Shanghai, and the Chinese consumer is not nearly as indebted as a number of other portions of the economy, and they are taking up the reins and producing economic growth. But that level of economic growth and type of economic growth is not particularly good for commodity markets, and that's the big story for the global economy and for South Africa in particular. So the take home here is that growth in China is weak, particularly the demand for global commodities is weak, and that's really troublesome for South Africa and the rand.